The Fed just reset the entire stock market and almost nobody is talking about it. I mean, the people who control interest rates in this country just handed regular, everyday people the best money opportunity we've seen in 15 years. And it's sitting there in plain sight. Your bank isn't going to tell you. Your broker isn't going to tell you. You know why? Because when you don't know this stuff, they make more money and you make less. That's not a conspiracy theory. That's just how the business works. I've been on both sides of that table. I've built companies from nothing. I've lost money, I've made a lot of money, and I've learned one thing over and over again. The biggest wins usually come from the boring stuff. Nobody's paying attention to right now, while everybody's glued to AI stocks, wondering out loud if that whole thing is a bubble about to pop. The smart money, the big funds, the guys who move billions of dollars before breakfast, they've quietly shoved $300 billion into something completely different in the last 6 months alone. 300 billion. That's not a guess. That's not luck. That's a signal, and it's a loud one. Today, I'm going to show you exactly what they're doing, why they're doing it right now, and how you can do a version of it too, no matter how much money you're starting with. Before I get into the meat of this, look, I don't do this for free out of the goodness of my heart. Nobody does anything for free. And if somebody tells you they do, check your wallet. I do this because I want you back here every single week learning this stuff with me. So hit subscribe right now. I mean, right now, pause the video and do it. So what I'm about to walk you through would cost you real money. If you sat down with a financial advisor and had them explain it to you line by line, you're getting it for free. All it costs you is one click on one button, do it, and let's get into it. So here's how we actually got to this moment. And I'm going to make it quick because you don't need a finance degree to follow along. You just need the basic shape of the story. The same way I don't need to know how an engine is machined to know when a car's running rough. Back in 2020, the world shut down overnight. Businesses closed. People stopped spending. The economy froze solid. So the Fed did what it always does in a crisis. It dropped interest rates all the way down to basically nothing. Free money everywhere, cheap loans, cheap everything. It made total sense at the time. You don't let the patient die on the table, but free money never stays free. There's always a bill that comes due later. All that cheap cash flooded into the system and prices took off like a rocket. Groceries, gas, rent, insurance, every single thing you buy got more expensive fast, and it kept climbing. So in 2022, the Fed slammed on the brakes hard and jacked interest rates up to the highest level we'd seen in about 15 years, trying to choke off that runaway inflation. And it worked. Sort of prices calmed down some. Then over the last couple of years, rates came down a bit and everybody exhaled and relaxed, thinking the hard part was over. Now here's the part that actually matters for you sitting there watching this video. The new leadership running the Fed is looking at the fresh numbers today, and prices are still climbing faster than the 4% a year. That's well above where they want it. Energy costs are heating back up too. So instead of cutting rates further like a lot of folks expected and hoped for, they're holding steady, keeping rates right where they are for now. That right there is the reset. That's the headline. Nobody's actually putting in a headline because it's not exciting enough for the evening news. It doesn't have a scandal attached to it. It's just math, and math doesn't get clicks the way outrage does. I've sat in enough boardrooms and watched enough deals fall apart to know one thing for sure. The moment nobody's talking about a number is usually the moment that number matters most. When everybody's yelling about the same 3 stocks on television, that trade is already crowded. The easy money's already been made. You're late. But when a change like this happens quietly, when the Fed just holds steady instead of doing something dramatic, that's exactly the kind of moment that gets ignored by regular investors and gets jumped on immediately by the people managing serious money. That's not an accident. That's the whole game. And while regular, hardworking folks are still watching their favorite tech stocks bounce around, hoping and praying for the best, something quiet has been happening behind the curtain for months. Big hedge funds have been selling chip stocks and hot tech names steadily, week after week. Wall Street's own research desks have flipped their favorite trade of the last few years into an outright sell. Recommendation: they didn't hold a press conference to announce it. You had to actually dig through the filings to find it, and most people never will. So where's all that money going? Instead, it's flowing into things that pay steady, reliable interest, nothing flashy, no headlines, just cash coming in like clockwork every single month. And I'll tell you something, I learned building businesses long before I ever cared about the stock market. When I see something boring making that kind of money quietly, I don't see it as boring. I see smart. Boring is often where the real money hides because nobody's crowding in and ruining the trade. The richest investors on the planet aren't guessing here. They've got rules, they've got systems built over decades, and right now, their system is telling them, lock in this interest rate while it's this good because it hasn't been this good in 15 years. And windows like this don't stay open forever. That's the whole ball game. That's why I'm sitting here making this video instead of talking about the next hot stock tip, because you deserve to know what the big guys already know, not 6 months from now when it's stale news everybody's already acted on. But right now, while the door is still wide open. Now, let me break down the two basic ways anybody actually makes money in markets. Because here's the thing, most people only understand one of them, and that's exactly why they're missing out on this whole opportunity. Years ago, way before I had any real money to my name, a buddy of mine wanted to open up a little food truck business. He needed $10,000 to get it off the ground. I had two completely different ways I could help him out, and understanding the difference between them is honestly the whole key to this entire video. Option one, I hand over the $10,000 and in exchange, I own a piece of the business. Let's say 10% of it. If that truck takes off, lines wrapped around the block every night, I could make $5,000 a year off my stake. I can make $50,000 a year. There's genuinely no ceiling on it. But if that truck flops and nobody shows up to eat his food, I lose my entire 10 grand. Probably every last dollar of it. Gone. That's what owning stock is. You're a partner, an owner, unlimited upside sitting right next to real painful downside. Option two is a completely different animal. Instead of owning a piece of the truck, I lent him the $10,000 outright. He signs an actual piece of paper agreeing to pay me 6% interest every year. So I collect $600 annually like clockwork, and in 5 years, he pays back my full $10,000 on top of that. Now here's the thing. If that truck becomes the hottest food business in the entire city and starts pulling in millions of dollars, I still only get my $600 a year. That was the deal we shook hands on. Nothing more. But if the truck just barely scrapes by breaking even most months, he still owes me that 600 plus, my full 10,000 back, no matter what. And if things go really bad and the whole business collapses completely, guess what? I get paid back before anybody who owns a piece of that business sees a single dime. I'm first in line at the door. That's exactly what owning bonds is like. You're the bank in that relationship, not the partner. Most investors walking around out there have only ever played option one their entire investing lives. Nobody ever sat them down and taught them option two. And honestly, for 15 straight years, there wasn't much reason to, because being the bank paid you next to nothing. Basically pennies. That's changed now, dramatically. And that's the entire reason we're sitting here having this conversation today. So let's build out what I like to call the ladder. 5 rungs total, running from the safest option all the way up to the riskiest. And you climb only as high as you personally feel comfortable climbing. Nobody's forcing you to go all the way to the top. And honestly, most people shouldn't. Look, I'm not a licensed financial advisor, and I'm a guy who's made a lot of money and lost a lot of money along the way. And I'm sharing what I've learned and what I understand about how this works right now. So still go do your own homework on top of this. Always rung one, the absolute safest place on the whole ladder is lending your money straight to the United States government. I know some of you watching are already laughing at that idea given everything going on, but stick with me here. The federal government brings in roughly $5 trillion a year in taxes and spends around $7 trillion, and that $2 trillion gap gets filled entirely by borrowing from people exactly like you and me, from other countries, from anybody willing to lend. They package that borrowing up into what are called treasury bonds. Why is lending to the government the safest bet on planet Earth, safer than any company you could name? Because the government can do three things. No company anywhere can ever do. It can raise taxes on hundreds of millions of people. Whenever it needs more revenue, it can literally print more of its own currency. And if it ever actually failed to pay back what it owes, the entire global financial system would seize up overnight. So genuinely, everyone on the planet has a shared interest in making sure that never, ever happens. There are simple, easy-to-buy funds out there that hold these short-term government bonds paying somewhere around 3.5% to 4% a year paid out to you every single month. And here's a nice little bonus. Most people have no idea about interest from these particular bonds is exempt from state income tax. If you're living somewhere with a brutal state tax bill hanging over your head, that detail matters a lot more than you'd think. Rung 2 moves you up one notch in reward and one notch in risk. Nothing crazy, just a small step up. Some countries out there basically operate under America's economic umbrella, places whose currency is tightly locked to the dollar and who lean heavily on the United States for military and economic protection. Because these countries aren't the US government itself, they have to offer a little more interest to convince people to lend to them in the first place, even though the actual risk stays fairly contained thanks to that American backing sitting behind them. There are funds built around this kind of debt spread across a handful of different countries so that no single one of them can sink the whole ship if something goes wrong locally. And these tend to pay somewhere around 5.5% to 6% a year. Stack that number up against inflation running just above 4%, and suddenly you're actually getting ahead of the rising cost of living instead of quietly losing ground to it every single year, which is more than most regular savings accounts out there can honestly claim to do for you. Now let's climb up to rung 3, where you stop lending money to entire countries and start lending directly to the biggest, strongest, most established companies in America. Think about the household names you already know well, the ones building massive data centers, expanding factories across the country, running enormous global operations day in and day out. These companies are constantly borrowing money to fund all of that growth. And when you buy their bonds, you're simply stepping into the role of lender to them. You get an actual contract in return if the company somehow can't pay you back. Bondholders like you get made completely whole before a single shareholder ever sees a dime out of what's left. There are funds built on short-term loans to these companies paying around 4 to 4.5% with very little bounce or drama in their value over time, and other funds built on longer-term loans to those same kinds of companies, paying closer to 5%, though the price on those does move around a bit more whenever interest rates shift up or down. Some savvy investors split the difference right down the middle, putting half their money into the short-term option and half into the longer-term, higher-paying one. So the two sort of balance each other out over time. That's a trick that professionals use constantly when they're not entirely sure which way rates are headed next. And honestly, it works pretty well. Rung 4 is where the risk really starts stepping up noticeably, so pay close attention right here. This is the part people get burned on if they're not careful. These are what people commonly call junk bonds. And I know that word sounds absolutely terrifying, like you're buying garbage, but all it really means is that you're lending money to smaller companies or to companies already carrying a heavier debt load than usual. The kind of companies that the ratings agencies out there label as higher risk. And keep in mind, these are the exact same agencies that once and confidently called bundles of subprime mortgages perfectly safe right before they helped blow up the entire global economy back in 2008. So maybe take their fancy letter grades with a healthy grain of salt, either way you look at it, because these particular companies are considered riskier. They have to offer noticeably bigger interest payments to get anybody willing to lend to them at all, sometimes 6.5% or even more, nearly double what you typically collect from the safest government bonds we talked about earlier. And when the overall economy is humming along nicely, These companies generally pay their bills just fine, and you sit back and collect a very nice check every month. But when the economy inevitably turns, and it always eventually turns, that's just how cycles work. Weaker companies start defaulting on their debts, and funds built entirely on this kind of riskier debt can drop 15, 20, even 25% in value during a genuinely bad stretch. This is absolutely not the kind of money you just park somewhere and completely forget about. This is a real live bet on the broader economy staying healthy and humming along. Rung 5 is different from every other rung on this ladder because it's not really about squeezing out more return at all. It's about keeping more of what you're already earning. This particular rung is built specifically for people sitting in higher tax brackets who are sick and tired of watching a huge chunk of their interest income get swallowed whole by the tax man every single year. The top federal tax rate sits around 37% right now. So if you're earning interest inside a regular old savings account, the government is taking an enormous bite out of it before you ever get to actually spend a dollar of it. There's an entire category of bonds out there, essentially loans to cities and states used to build roads, schools, bridges, that kind of infrastructure. And these particular bonds come completely exempt from federal tax and sometimes exempt from state tax too, depending on exactly where you happen to live. Run the actual math on $1 million sitting inside a regular savings account earning 3% a year. You'd owe enough in taxes on that interest that you might only actually keep about 2/3 of it in your pocket at the end of the day. Now put that exact same $1 million into a fund built entirely on these tax-free city and state bonds, paying a similar rate, and you keep essentially all of it, every last cent, on real money. That gap adds up to tens of thousands of dollars a year. The same amount of money invested, completely different outcome purely because of where you chose to park it. Obviously, go check in with your own personal tax advisor before you move a single dime, based on anything I'm saying here. I'm just laying out the basic concept for you, not doing your actual taxes for you. Here's the overall picture I really want you walking away with today. Most everyday, regular investors out there are flying a plane with only one engine running, and that lone engine is stocks and growth. Buy the ticker, hope it goes up, cross your fingers. That's the entire strategy for millions of people. And when that single engine sputters, and every engine sputters eventually, there's absolutely nothing else keeping that plane up in the air. The big money, the true professionals, they always fly with two engines running at once. Engine 1 is stocks and growth, same as everybody else. But engine 2 is bonds and steady interest income. And for 15 straight years, that second engine was basically completely dead, paying next to nothing. So an entire generation of investors flat out forgot it even existed at all. But the Fed just rebuilt that second engine from scratch, and right now it's running at full power for the first time in over a decade. The professionals noticed instantly, and that's exactly why $300 billion moved into it in just 6 months flat. Nobody's telling you to dump all your stocks tomorrow morning, and neither am I. That would be terrible advice. I'm simply telling you that flying around on just one engine when a second fully powered engine is sitting right there available to you is leaving real performance on the table and leaving money on the table has never once in history made anybody rich. Think about every business I've ever built or invested in. The ones that survived the rough patches weren't the ones betting everything on a single outcome. They were the ones that had more than one way to win. That's not just an investing lesson, that's a life lesson, and it applies here just as much as it applies in business. Having a second engine doesn't mean you've stopped believing in growth. It just means you've stopped betting your entire future on one single throw of the dice. So here's your challenge, and I genuinely want you to actually go do this, not just nod along politely and close out this tab like it's just another video. Pick exactly one rung on that ladder, just one, whichever one matches how much risk actually lets you sleep soundly at night, and go look into it. Seriously this week, not someday down the road. This week, while it's fresh in your mind. Write down which one you picked and why you picked it, and drop that in the comments below. Because I guarantee you, somebody else reading through those comments is wrestling with the exact same decision you are. Right. Now, money has never once rewarded the person who simply knows the most facts. It rewards the person who actually moves and takes real action. The Fed just handed you an opening that genuinely hasn't existed in 15 years. And openings like this one don't sit around waiting patiently forever. They close, usually quietly and without warning. So go do your homework properly. Talk to somebody who actually understands your full financial picture and then act like it actually matters, because it absolutely does. I'll see you in the next one.